What's your business worth? I'll tell you what most owners do. They get a number from their broker, they like the look of it, and they build their whole retirement around it. Then a buyer walks in, runs the same business through a different valuation method, and that number drops by $900,000. Same business, same financials, same day. That's not a negotiation. That's a wipeout of your expectations. And the seller never saw it coming. Your broker gave you a number, and I'd be willing to bet that number was built around one valuation method, maybe two. But the buyer sitting across the table from you, they're going to run your business through 3 to 5 valuation methods, and they won't just pick one. A sophisticated buyer will run 3 or 4 methods, compare the results, and triangulate a valuation somewhere in the middle. The method they choose to lead with in negotiation tells you how they see your business. It's a clue, and where they see the weakness in your business. So if you don't know which method a sophisticated buyer is going to use on your business, you're negotiating blind. I've been on the buy side of acquisitions, and I've built and sold my own company. What I saw buyers do with valuation methods and what sellers never knew was happening is exactly what I'm going to walk you through today. 5 methods, what each method means for your sale price, and which ones you need to be ready for before you go to market. Most sellers go to market with one number. Their broker calculated it and it looks reasonable, and they've anchored everything to that figure. Their retirement plan, their timeline, their sense of what's fair and what's right. The problem is that number was almost certainly built around just one method, and it was built to get you to market, not to survive a buyer's due diligence. When I was on the buy side, we had a checklist, and that checklist didn't start with one valuation method. It started with the question, which method makes this business look riskiest? Because that's where we began our negotiation. I say this not to frighten you. I say it because understanding what a buyer doing with these numbers is the single most powerful thing you can do before you go to market. So let's go through all 5, and I want you to think about your business as we do this, because by the end of this video, you're going to know which method a buyer is most likely to use on you, and you're going to know why. And you may have an idea of which valuation method is right for you as well. Method 1, SDE, or seller's discretionary earnings. In Australia, we sometimes call it proprietor business income after add backs. Different names, same idea. Here's how it works. A buyer takes your business profit, adds back your owner's salary, and then adds back any personal expenses you've been running through the business, the car, the phone, the conference in Bali that was technically a business trip. That combined figure is your SDE. Then they apply a multiple, typically between 2 and 4 for small to mid-sized businesses. And here's where it gets uncomfortable. That multiple is not fixed. It moves based on risk. A clean business with recurring revenue, a strong team, and a no owner dependency might get a 4 times multiple. A business where you are the business, you hold all the relationships, you do all the selling, and you're the face of every client call, that business might get 2, maybe 2.5. And let me show you what this looks like in practice. I watched a buyer evaluate a business initially valued at $1.6 million. Good revenue, solid margins, nothing obviously wrong. Then due diligence started, and the buyer discovered the owner was doing the work of 3 people: sales, operations, and key client relationships, all sitting with one person. By the time they adjusted for what they would actually cost to replace that owner, the valuation came down to $1.1 million. That's $500,000 gone. Not because the business was bad, because the multiple moved. Method 2, EBITDA multiple. This is the method buyers use when their business starts getting bigger. Once you're above roughly $2 million in revenue, sometimes less, buyers and their advisors shift from SDE to EBITDA, earnings before interest, tax, depreciation, and amortization. The key difference is this. EBITDA doesn't add back your owner's salary. It assumes management is already in place, And if you're still running the business yourself and drawing a salary, that salary stays in the cost base. It doesn't get added back as earnings. For some sellers, this is a shock. I saw a seller told their business was worth $2 million using SDE. They were ready to go to market. A buyer came in, ran the numbers using the EBITDA method, and the valuation came back at $1.4 million. Same business, same financials, same day. The calculation methodology changed, not the business. Multiples at the EBITDA level are typically higher, 4 to 6 times for a well-run business, sometimes more for the right industry and growth profile. But you need the earnings to be there first. The question to ask yourself, if I took my salary out of the business completely and replaced myself with a salaried manager, what would the profit look like? That's the number a buyer using the EBITDA method is starting from. Before we go on to method 3, if you're watching this and realizing there are gaps in how your business has been valued, drop a comment below and let us know. Has your broker explained why they used a method they did? Or did they just hand you a number? I read every comment and I will reply. And don't forget to like or subscribe. It helps more than you know, and hopefully we can help other people together. Now, on to method 3, asset-based valuation. This is the one that surprises sellers the most. And when a buyer uses it, it tells you something important about what they think of your business. Asset-based valuation is exactly what it sounds like. The buyer adds up everything the business owns, equipment, inventory, property, intellectual property, and subtracts what it owes. The resulting number is the net asset value. And here's the uncomfortable truth. Buyers use asset-based valuation when they don't believe the earnings are sustainable. When they look at your profit and think, I just don't trust it. So they switch to what they could get for it if they wound the business down and sold the pieces. For a service business, a consulting firm, a professional practice, an agency, this method can produce a number far lower than SDE or EBITDA because service businesses don't have a lot of hard assets. Their value is in their relationships, their systems, and their reputation. And a buyer who uses asset-based valuation is telling you they don't see those things as reliable. If a buyer tries to anchor your price using asset-based valuation on a profitable service business, that is a negotiating position, not an objective assessment. And you need to know that walking in. Method 4, market comparables. This is the method that sounds the most objective. And in the hands of a smart buyer, it's anything but. Market comparables work exactly like real estate. A buyer looks at what similar businesses have sold for recently, same industry, same size, and similar geography, and uses those sale prices as a benchmark for what your business is worth. The problem is that comparable businesses' sale data is not publicly available the way property data is. Your broker has access to some databases, so does the buyer's advisor. And the deals they choose to highlight, the ones they use as your benchmark, are entirely within their control. I've been in rooms where a buyer's advisor selects comparables that skew low. Businesses that are sold under pressure in a declining market or with structural problems that bear no resemblance to the business in front of them. And if the seller doesn't push back with their own comparables or doesn't know how to push back, that low benchmark sticks. Your job before you go to market is to know what businesses like yours have actually sold for. Your broker should be providing you this. And if not, ask for it. Method 5 is discounted cash flow, or DCF. This is the one sophisticated buyers use when they want to get precise. Here's the simplified version. Instead of looking at what your business earns today, a buyer projects what your business will earn over the next 3 to 5 years. Then they discount those future earnings back to what they're worth in today's money. Because $1 in 3 years is worth less than $1 today. The reason this matters for sellers over 50 is that DCF is highly sensitive to growth assumptions in the future. If a buyer believes your revenue is going to plateau or decline, maybe because you're close to retirement or because your industry is changing, they'll use conservative growth projections. And a conservative growth assumption means a lower valuation. And this is where earnouts come from. An earnout is when a buyer says, I'll pay you part of the purchase price now and the rest later, based on whether the business actually hits the performance numbers I'm projecting. For sellers who are planning to exit completely, say retire, an earnout can feel like a 2-year sentence with a new boss. I've seen sellers accept earnouts without fully understanding what they were agreeing to and spend the next 2 years fighting to hit targets in a business they no longer controlled. If a buyer is offering you an earnout, it's because they don't fully believe the numbers. That's not always a deal breaker, but it needs to be negotiated hard. Which methods matter most for your business? Well, the weight a buyer puts on each method depends on what you're selling. If you're in manufacturing, logistics, or any other asset-heavy industry, asset-based valuation carries real weight. The equipment, the inventory, the property, those are tangible. Buyer can see them, value them, and finance against them. If you're running a service-based business, consulting, professional services, or an agency, SDE or EBITDA will dominate. Your value is in your earnings, your client relationships, and your systems. Hard assets barely move the needle. And if you're in a high-growth sector, tech, software as a service, anything with strong recurring revenue, expect buyers to lean on DCF. They're buying the future, not the present. Growth assumptions become everything. Knowing which methods matter most to your type of business tells you where to focus your preparation and where buyers are most likely to push. Here's what I want you to take away from this. In practice, most sophisticated buyers don't rely on a single method of valuation. They'll run 3, sometimes more, methods and triangulate a valuation that sits between them. The method they lead with in negotiation isn't necessarily the one they'll believe. It's the one that gives them the most leverage. You're not going to be valued using one method. You're going to be valued using at least 3 methods, sometimes more, simultaneously, depending on who's sitting across the table. And the method a buyer chooses to lead with tells you exactly how they see your business and exactly where they're going to push in negotiation. The sellers who exit well aren't the ones with the highest revenue or the longest track record. They're the ones who understand how buyers think. This isn't just about valuation, it's about your retirement, your options, your choices, and your freedom. And you have worked too hard and too long to leave that to a process you don't fully understand. If this has resonated with you, and if you've heard something today that changes how you're thinking about your exit, drop me a comment below and tell me where you are in the process. Are you 2 years out, 5 years out, already talking to brokers? I genuinely like to know. And if you want to go deeper into SDE and how buyers use it to reduce your multiple during due diligence, I've covered that in detail in a video right here. Remember, look after yourself, not just your business. And we'll see you in the next one.